So as we transition into chapter 11, we're shifting from chapter 10, which really should have been called bonds, but we called it long-term liabilities, into chapter 11, which we're going to deal with transactions relating to stock, the purchase and sale of stock, and also transactions with stockholders, i.e. dividends. So that's kind of what we're going to do in this chapter. What we're looking at here, corporate form of organization. You get much deeper into this in your B-Law 2080 course. So you may be taking that, or you may have already taken it, or you may be taking it soon. So I don't heavily test this area. I know the guy who teaches it. He does a good job. So you'll get you'll get most of this in that course. All right. But the quick run through. The corporation is an entity created at the state level under state law, and it is separate from its owners. All right. It's a legally separate entity from its owners, and that means when a corporation is sued, the owners are not sued personally. The corporation is personally responsible for the corporation is responsible for its own liabilities. Right, the owners are not. Right, it has the rights and privileges of a legal person, which basically means it can sue and be sued. It can own property, can buy and sell property. All right, they can be publicly held. And the largest corporations typically are publicly held. These are your Walmarts and your General Motors and your Delta Airlines of the world, right? If you have money, you can actually go buy shares of stock in these companies. Or they can be privately held. And these companies, there are several very large privately held companies as well. Coke, the Koch brothers, Koch Industries was one example. If you've ever watched S.C. Johnson Wax, it says at the end the family company. That means it's privately held. Or if you've ever seen a commercial for S.C. Johnson Wax, you know, they make Lysol and things like that. That's a privately held company. All right. So a lot of information duplicated from the previous slide here, but we'll talk about some of the things. Of course, it is a separate legal entity. You can buy shares of stock in a corporation, and your liability is limited to the investment in that stock. So if I own shares in Walmart and Walmart is sued, Walmart goes out of business, my stock can become worthless, but my liability stops at the value of my stock. All right. Easily transferable ownership. All right. So if I decide I don't want to own a certain stock anymore, I can sell it. All right. Continuous life, and then really what that means is that since a corporation is a legal fiction, it exists until it's legally ended, i.e. it goes out of business, it goes bankrupt, or the shareholders mutually agree to discontinue business. All right. We'll skip that. You'll get that in 2080, B-Law 2080. Ease of capital accumulation. So the old saying goes, it takes money to make money. In the corporate form via chapter 10, bonds, and also this chapter, sale of stock, can generate a lot of money in a relatively short time. All right. So that's perhaps the biggest advantage of the corporate form. Disadvantages: corporations are the highest regulated entities that exist. They have to obey all relevant business law, and then also all of the law in the corporate code. All right. And then corporate taxation, which the corporation itself is taxed, and then when they pay dividends to shareholders, the shareholders are taxed on those dividends. All right. So heavily taxed entities. All right. Quick fly through of corporate structure. And again, you'll get more of this and more deep into the roles that each of these actors play in the corporate form. And you'll get deeper into this in 2080. But structure, stockholders are the owners of the corporation. Their main job is the election of a board of directors. And the board is responsible for long-range planning for the company. And they also hire, fire, evaluate, and compensate high-ranking managers. Usually that's anybody with chief in their title: chief executive officer, chief financial officer, chief operational officer. All right, more and more you're seeing chief IT or chief information technology officers. And then there's everybody else, all right, that reports to upper management. All right. See, rights of stockholders. If you own stock, you can sell it at any point that you have a willing buyer. All right. You can buy more, and this comes into play when a company issues new stock. So if I own 20% of Walmart, I'm a rich man. If I own 20% of the shares of Walmart, and Walmart is bringing new stock to market, I can buy 20% of that new stock, and that way I'll still have 20% control of all the stock and all the votes that come with holding that much shares of stock. Receive dividends, which are payments of money. All right. If the company if the company pays dividends, all stockholders have the right to receive equally in that dividend. All right, and we're going to get there on Wednesday. We'll start talking about dividends on the April 15th lecture. All right. Share equally in any assets remaining after liquidation. So if a company goes bankrupt, there's what we'll refer to as a liquidating dividend. And shareholders are going to share proportionally. Like if I own 20% of the shares, I would get 20% of that liquidating dividend. All right. Here is a stock certificate. These aren't issued all too often anymore. Most of the time it's digital. All right. But this is a share of stock. Green Bay, which you may or may not know, is the only publicly held NFL team, and I believe the only publicly held professional sports team amongst the big four: MLB, NFL, NBA, and NHL. They ordinary people can buy stock in, right? And generally the way it works is shareholders are entitled to purchase season tickets, right? That's how it works for Green Bay, all right? Okay, so let's talk about the accounting, all right? Par value, and we know what that meant when it related to bonds. It's much less important related to stock, all right? It's really just an arbitrary amount, a made-up amount. Usually it's a very, very small amount in real life. What we'll see is that when we work through problems, they're probably larger than you would typically see in the real world. But it initially existed as a floor below which shares of stock could not be sold. All right. And it also, from an accounting perspective, had to be held separate from other funds. And we'll see that when we start in with making journal entries as it relates to the sale of stock. All right. And there's market price. All right. Market price is what determines what the stock actually will sell for. All right. And keep in mind that most stock transactions are investor to investor. Companies really only sell their stock once. Right? Typically, they only sell their stock once. We'll talk about the exceptions. And of course, that generates revenue. But that investor may sell the stock to another investor at some point in time in the future. So most transactions in stock are from one investor to the next. It's only the initial sale, and that's what we're going to be journalizing, the initial sale that benefits the company, at least directly. All right. Classes of stock, par value, no par value, and stated value. We'll go through these. Each has a slightly different way of journalizing it, and we'll walk through each of these three types. Stockholders' equity. Now, that's an account that we have worked with a little bit. And so when we think about that, it consists of a couple of pieces. Contributed capital or paid in capital. If you remember way back from chapter 2, like the owner investment in a company. I own a company and I invest $10,000 and also $20,000 worth of equipment. Well, all of that's paid in capital, and in exchange, the owner would receive stock if it's a corporation. All right. And then, of course, retained earnings, which is the result of previous period operations, right? Not distributed. So if a company has made $10 million in a prior year and they didn't pay a dividend, then retained earnings would be $10 million. All right. So that's how that works. And again, we'll see all this in application. Okay. A few more points that I want us to know now, but also for the next couple of lectures as it relates to Chapter 11. All right. So when a corporation is formed, they list a number in the corporate chartering document. Right. That, you remember a few slides ago, the beginning of this lecture, we said that a corporation is formed under state law. All right. And it's done with a corporate chartering document. All right. So in that document, there's just a number. Usually it's a huge number, but that's the upper limit as to how many shares of stock a company can sell. Right. And those are authorized shares. It's the number of shares a corporation can issue without modifying their corporate charter. All right. Usually a huge number. There's no reason to be conservative there because companies may bring shares to stock, and it's easier to do it if you don't have to reissue that charter. All right. Issued shares. All right. So I started a company and I have, 5 million shares authorized. All right. And I decided to sell 1 million shares of stock. All right. So once those 1 million shares are sold, those are issued. All right. They're in the hands of stockholders who have chosen to invest in my company. All right. Treasury stock. All right, and we'll get into the accounting for treasury stock. So, if a company believes that its shares, its own stock, is undervalued, all right, the company may decide to buy back some of its own stock, right? And it's so called because when a company buys back its own stock, that stock is held in treasury, all right, in the company's treasury. Now, this has the effect of increasing the stock price, because if a company is going to buy back a big chunk of shares from the open market, it's supply and demand. You reduce the supply available for sale, which tends to drive up stock price, which is good for the company. All right. Now, companies can only buy back shares that have previously been issued, that are in the hands of stockholders. All right. Companies have the right to buy back their own stock. When they do, those shares are referred to as treasury stock. All right. Outstanding. All right. These aren't the best of the best shares. No, it's really kind of a mathematical formula. Issued shares less treasury stock are shares that are outstanding. So in the example I used a moment ago, if 1,000,000 shares are issued and treasury stock, the company has bought back 100,000 shares, then the outstanding shares are 900,000. That's all that is. So it's the differential. Outstanding shares are the differential between issued and treasury. All right. Okay, that's all for now.